Hey traders, I just want to talk to you about a trade which we took in September 2017, which was on the weekly with the US dollar versus the South African rand. A lot of attention is paid to getting into the market, but when it comes to managing and exiting the trade, a lot of people are pretty clueless as to knowing exactly what to do. So I really want to share this trade example with you so that you can see the full picture as to not only how we identified the trade, but how we entered the market and also how we managed the trade and exited it. So you get the full picture. So first things first, in September 2017, we identified here that the South African rand versus the US dollar was in a lovely, stonking, big upward trend from 2011 all the way to the highs of January 2016. Now, as we can see, from 2016 all the way to 2017, we've been in a period of retracement for well over a year. But what was interesting about this retracement was that it actually came down to test more or less the 50% Fibonacci retracement level. And those of you who've been trading for a while can appreciate that nothing ever goes up or goes down in a straight line. There are minor and major retracements, there are complex retracements, and this retracement here, which we saw from 2016, January 2016 to September 2017, is not atypical of a retracement in a long-term upward trend. And this symmetrical triangle, which we identified as well, is not atypical of a continuation pattern in an upward trend. And as you can see here, we've got this, indecision, and that is the hallmark behind a symmetrical triangle, where we've got higher lows but also lower highs, and you can see it funneling into like a triangular pattern. And we have the apex here, which is where this trendline level of resistance crosses over with this trendline level of support. And typically when we do get the breakout of this in the direction of the prevailing trend, we do get a continuation in the direction of the prevailing trend. So what we did was we identified this bullish pin bar reversal here as our buy signal at the bottom side of this triangle, and we figured that if we were to enter just at the break of the high here with our stop loss below the low, even if we were to trade it to this trendline resistance here, then we'll get about 1.5 to 1 in terms of our reward to risk. So that would be very well worth taking. And what is more is that we could be in this move prior to the breakout in what could be the continuation of the prevailing trend. Remember that if we simply have this much risk with our entry above the high of this bullish pin bar reversal with our stop loss below the low, and if as and when we get up to this point here and this symmetrical triangle breaks out to the upside, just imagine if we had all this potential gain over the course of the coming months or years even. It's a fantastic reward to risk. In fact, if it played out, then it would be possibly the best trade of the year. So obviously nothing is guaranteed when it comes to financial markets trading, and we tend to make hay while the sun shines when the conditions are favourable. So what we did to enter was we traded this one as one of our standard entry, with our entry just above the high with our stop loss below the low. And after the first week, we got triggered into the trade. There we go. What happened as well was the fact that we actually had price getting to our first target here. But what was curious about this instance after week 2 was the fact that we had a bearish pin bar reversal, which is not really what we wanted to see, because as we're looking to buy and go long, we want price to leave this area here and continue upwards rather than ricochet and reject this trendline resistance and go back down. That's the last thing we want. So as per our strategy rules, we trail our stop loss below the low of every second buy bar. So we moved our stop loss below the low of this bearish pin bar reversal, because if it did break short or go down, then it's pretty likely that it was going to go all the way down to the bottom at this trendline support here before going back up again. We didn't really want that. We didn't really want to be in a nicely profitable trade and for it to go into a loss. That's trading 101. You don't want a profitable trade to turn into a loss, especially if you've made more than what you've originally risked. So we moved our stop loss below the low of this second bar here to lock in profit, but also keep ourselves in the game just in case we did see the surging price continue to the upside. So there, we're glad we did, because price didn't even come down to our stop loss we always place at a point where if the market does test our stop, then the setup is generally invalid, or should I say the trade is no longer valid. So we've had the close above this trendline resistance, and we're out of this triangle now, which is fantastic. It's exactly what we wanted to see. And then we've got the close of our second bar. There we go. So as it's another, or bar 4, we're in week 4, 1, 2, 3, 4. So we move our stop loss below the low of this buy bar here to lock in profit again, and we advance into week 5 thereafter, and there we have it. We got stopped out at a decent profit. I believe we made about 4% risky 2% with this trade, and this is not atypical of our style of trading. Of course, we had the market, or the US dollar, weakening to test this level here, and that is typical. Whenever you get a trend line broken, typically the market will come back and test that prior to continuing in the prevailing direction. And then we had the market go up again, got stopped out, and lo and behold, the US dollar weakens against the South African rand. So we're pretty glad we exited when we did. That was a very mechanical style of trading this, and in order for a trade management style to be effective, it needs to be mechanical. And you need to systematically lock in profit and mitigate yourself, or mitigate against risk, and of course be strategic in the way you place your stop loss, because there's no point in being stopped out of a trade early, because to your horror you could quite often find it goes in your favor without you. Conversely, if it's going against you, it's very important to keep that stop loss in place, because it's there for a reason. Like I mentioned, stop losses should be at a point where if the market does test the stop loss and trigger you out of the trade, then the setup is invalid. Okay, so that is a walkthrough of the trade we took in September 2017 with the US dollar versus the South African rand.